Welcome to This Explainer. Today, we're looking at strategic tax deficits, an analytical report on loss harvesting. We're going to take a highly analytical approach to unpack a completely paradoxical idea, using your financial losses to actually build tangible wealth.
Okay, let's dive into this. How do portfolio deficits actually generate tangible wealth? Human psychology totally wires us to view an investment loss as a massive failure, right? It's a negative we instinctively want to ignore. Staring at a losing position in your portfolio causes immense psychological friction. We naturally just want to wait it out and hope the market corrects our mistake. But to really grasp the insights from the expert report we're analyzing today, we have to completely rethink that emotional response. We've got to look past the pain of a depreciated asset and instead view that deficit as a functional, mechanical tool. A tool you can deploy right now to legally shield your overall wealth. So what exactly is tax loss harvesting? Well, the report defines it as the strategic selling of depreciated assets to systematically offset realized capital gains. The key word here is systematic. We're no longer looking at a portfolio as just a random collection of stocks. Instead, it's a balanced mathematical equation. Activating the negatives can perfectly cancel out the positives. Look, every single investor has a few losses. That's just a mathematical certainty over time. But harvesting those losses, that requires structural precision. It's a highly active, mathematically driven process. And this brings us to a really critical distinction, one that a lot of novice investors completely misunderstand. Let's compare a paper loss versus a realized loss. If you're just holding on to a declining asset, watching the price drop, you've only got a paper loss. Sure, your net worth is down on paper, but that position has absolutely zero tax utility. See, the implicit assumption in the tax code is that it only cares about executed transactions. It completely ignores unrealized potential, whether that's positive or negative. A portfolio loss only transforms into a taxable asset once it's legally realized. And how do you realize it? By executing a strategic sale to trigger those dormant mechanisms in the tax code. The key word is sell. Without realization, the mechanism remains dormant and yields zero tax utility. Everything hinges on that single action. Actually, inaction is literally the absolute enemy of this strategy. Holding on to a loser, just hoping it bounces back, that's an emotional bias. It's a psychological trap. Selling that asset to realize the loss is a cold, analytical, strategic calculation. This entire framework completely relies on that definitive trigger, the execution of the sale. You've got to pull the trigger to activate the math. Moving into phase 2, mathematical cause and effect, netting the gains. And this brilliantly illustrates exactly how this works in practice. We're mapping the direct cause and effect relationship between the assets you sell and your final tax footprint. Let's walk through these exact data points from the report. Say you take action and sell asset A, locking in a $10,000 gain. In isolation, that $10,000 creates an immediate tax liability. But acting strategically, you look at your portfolio and sell asset B, which is currently sitting at an $8,000 loss. That deficit doesn't just vanish into the void, it goes to work. It actively consumes $8,000 of that $10,000 gain you just triggered, leaving a final net taxable exposure of exactly $2,000. Let's really think about the impact of that number. Instead of facing the government with a $10,000 profit and paying taxes on that whole chunk, you're presenting a severely minimized footprint. You still got the economic benefit of the big win on asset A, but by pairing it with a strategic loss, you engineered a drastically lower tax bill. Retaining more of your capital by deploying your deficits with surgical precision, that's the core of this wealth generation strategy. That brings us to phase 3, the spillover protocol, maximizing excess deficits. So what happens when the math tips the other way? What if your realized losses actually exceed your realized gains for the year? Well, it revolves around this highly specific figure, $3,000. The report notes that if your strategic losses exceed your capital gains, authorities allow a strict maximum annual deduction of up to $3,000. But here is the non-obvious detail you absolutely need to catch. This deduction isn't just applied against other investments, it applies directly against your ordinary income. That means your portfolio losses are actively shielding your W-2 wages or your business salary from being taxed. You are functionally putting cash directly back into your own paycheck. Let's break down the structural flow of this spillover. Step 1. Offset all capital gains entirely. You use those harvested losses to bring your investment tax liability down to absolute zero. Step 2. Offset up to $3,000 of ordinary income, shielding your standard wages. And then we hit Step 3, which is a real game changer. Carry the remaining excess loss forward to the next fiscal year. This carry-forward mechanism is indefinite. Those excess losses don't just vanish when the year ends. They essentially become an accumulated tax asset on your balance sheet, rolling forward year after year, actively waiting in the background to neutralize any future gains you might have down the road. Next up is Phase 4, regulatory constraints, the 30-day boundary. To stop people from just blatantly exploiting this math, the tax code has some incredibly strict boundaries. The wash sale rule is a regulatory constraint that nullifies a tax loss if an identical or nearly identical investment is repurchased within 30 days. We have to understand the logic here. The authorities are hunting for phantom losses, situations where your true market position hasn't actually changed. They assume that if you sell a stock for a loss and buy it right back a minute later, you didn't really suffer an economic loss. You're just generating a paper trail. And the system is rigorously engineered to detect and reject that behavior. Let's visually map out this chronological cause and effect so the mechanics are crystal clear. Day 0, that's your strategic sale of the asset. Then, from days 1 to 29, you are in the restricted regulatory window. You literally cannot touch that identical asset. You can't buy it in another account, your spouse can't buy it. It's a strict binary timeline. It's not a suggestion, it's a rigid boundary demanding absolute compliance. Finally, on day 31, the window closes and a safe repurchase is authorized. This timeline dictates exactly how and when you can get back into a position while keeping your legal tax benefit perfectly intact. Premature repurchase nullifies the strategic offset. Chronological precision is an absolute requirement. I really can't emphasize this enough. If you violate this timeline constraints, the mathematical advantage you just engineered entirely collapses. If you buy back that same asset on, say, day 28, the loss doesn't just get paused, it's outright disallowed for the current year. Mechanically, that disallowed loss gets baked permanently back into the new cost basis of the repurchased asset. So while you might get a tax benefit years from now when you finally sell it again, your immediate strategy is completely ruined, and your tax exposure for this year stays fully intact. And that brings us to the concluding thesis from the expert report: turn investment losses into tax victories. It perfectly sums up the analytical journey we've been on today. We've looked at how to take a mathematically negative event, a drop in market value, and transform it into a highly structured, compliant, and positive strategic outcome. It's absolutely crucial to realize this isn't some shady loophole. It's a highly intentional structural feature of the financial system built specifically for those who apply strict analytical rigor. It's all about stripping the emotion out of investing and looking at your portfolio purely as a system of interconnected levers. So I'll wrap up this explainer by leaving you with a final thought to chew on. Are you holding dormant portfolio deficits right now that could be engineered into active wealth? Take a moment today to rigorously reevaluate your own portfolio inefficiencies through the analytical lens we just established. Stop looking at your investment losses as emotional failures. Start recognizing them for what they mathematically are: unharvested utility. I hope this structured breakdown empowered you to look at your assets a bit differently. Keep analyzing, and we'll see you in the next explainer.